Hi, everyone. Welcome to the Future of Finance podcast. I'm George Dyer, and today's guest is Alex Wright-Gladstein, founder and CEO of Sphere, a mutual fund company making it easier for people to invest their retirement savings without investing in the fossil fuel companies that are driving climate change. A lot of people don't think about what's in their 401ks, and not surprisingly, they are quietly investing in the fossil fuel industry month after month. It can be hard to convince retirement plan administrators to include fossil fuel free options in the lineup. So many people are essentially forced to invest in the sector. Sphere is on a mission to change that with their low cost mutual fund that checks all the boxes for plan sponsors. And I talked to Alex about the financial performance and risks of investing in the sector, her views on the impact that fossil fuel divestment can have, and specific actions individuals can take to get their retirement savings out of fossil fuels. This is a great one for individuals who want to take direct action. So if you care about where your money is invested, how it shapes the future, this is a conversation you won't want to miss. I hope you enjoy it and pass it on. And let's jump in. Alex, welcome to the podcast. Thanks so much for being here.
Thank you so much for having me, George.
It's great to see you. How's everything going?
The world is crazy these days, but things are
Mm-hmm.
actually going really well at Sphere. I think people are realizing that when they can't control what's going on in the world, one thing that they can control is their money. And
Mm-hmm.
so our customer base is growing as a result. So that's good.
That's fantastic. Nice. So I'm excited to hear all about it. And let's just start there with a little background about how you started Sphere and why.
So I've been passionate about turning around climate change my whole life, ever since my seventh grade science teacher opened my eyes to the issue. And I decided early in my career that I wanted to be a serial entrepreneur. And I thought if I could help get technologies out of labs that would have an impact on climate, that could be worthwhile. So I ended up going to MIT for my MBA as an excuse to meet people across campus inventing things, which was amazing because there are over 300 labs at MIT that do energy related research. And I got to meet a lot of the people in those labs. And that's where I met my co-founders for my first startup, which is called IR Labs. And they had invented the first processor chip to communicate using light. We spun that technology out in 2015, and we are cutting the energy use of AI in half by using light to move data between chips. Now, in 2017, we started offering a retirement plan to our employees. And I asked for a climate friendly investment option in the lineup. And it ended up taking over 3 years and a lot of persistence to get a single investment option for our employees that wasn't invested in fossil fuels. And I just couldn't believe how long it took and how hard it was. And so it started me down this rabbit hole of just trying to understand how 401k decisions get made, why it was so hard, even for a CEO asking service providers to get a thing done, to get that thing done.
Mm-hmm.
Um, and I ended up realizing that I wasn't alone and that it wasn't just other climate tech founders like myself looking for these options. It turns out there are entire social movements of employees at big tech companies, at Microsoft, at Apple, at Google, who have been asking for climate friendly investment options for years and not getting them for similar reasons to why I couldn't get them. And so I realized, wow, um, I think maybe I can have bigger impact on climate change by having my next company not be spinning another technology out of a lab as I thought I'd be doing over and over again, but instead fixing this 401k issue just to make it easy for everyone to invest their retirement savings in a climate friendly way.
Mm-hmm.
And so hired my replacement as CEO at IR Labs and started here to do that.
I love it. It's such a classic serial entrepreneur story. And I mean, we could spend have a whole nother podcast conversation about IR labs. I mean, that's so cool. And so classic MIT, it sounds like using lasers to get more energy efficiency. But no, I just love the evolution. And I think it underscores too, your point and sort of epiphany about the real impact that money and investing has on this shift. And maybe dive into that a little more. I mean, what is your sort of thesis or theory about how 401k plans and retirement funds can help in the fight against climate change, and what really the impact is of people shifting their funds to climate friendly plans?
Yeah, when I first started Sphere, I didn't even have all the data on the numbers, but now that we've been really digging into it for a few years, it's really mind blowing how much impact we can have by moving our money. Retirement investments in the US there's $30 trillion in the US in retirement savings. Of that, about 1 trillion is invested in fossil fuel companies. And that 1 trillion makes up one fifth of the market cap of the US fossil fuel industry. And this is coming from people who have no option to invest otherwise. Over 99% of people invested in their retirement plans have no option that's not invested in the fossil fuel industry. And so they're all investing by default in this industry. And it turns out it's an industry in decline. It's not just this hypothetical potential future thing where the fossil fuel industry could go into decline. I think a lot of people have a sense that that is likely to happen in the future, just given how solar and wind have been taking off and batteries and electric cars are popular. But it turns out that actually, in a backward looking sense, it already has been in decline for a long time. Over the past 2 decades, the fossil fuel industry has had the worst returns of any sector of the economy for 2 decades now. And
Mm.
so it already has been a losing bet to invest in this industry. And yet we've required everyone saving for retirement to put some of their life savings in this industry in decline. And so once I realized the financial numbers and the trends that this is an industry in decline and realized, wow, this is a significant amount of money that's holding up, really propping up this industry that's in decline.
Mm.
It's 1/5 of their market cap. I realized, wow, I think we probably could have an impact by moving some of that money, or at least giving people the option to not invest in this industry and not keep propping it up. And does that have an impact? Well, you think about it, the fossil fuel industry is one that just has a huge social license. As I think Bill McKibben would say, kind of one of the first people to talk about divestment, right?
Hmm.
Um, right now in society, we still give them that social license to do what they do. They have an enormous amount of power in politics in Washington, D.C., and they're preventing just common sense policies from getting put in place that would transition us to a safe planet for us all to live on. And as long as we keep investing our money in that industry, they're going to continue to have that social license. So moving money does something. It shines a spotlight on this industry in a way
Hmm.
that just marching on the streets or just talking about it around the dinner table does not.
Hmm.
And so, what kind of impact could this have? I actually really believe that this can have a bigger impact than any other company I could have started spinning any technology out of a lab, especially on the timescales that we need right now, right? Like this is not something where it's for future generations. It's for the currently living generations. It's right now. It's I'm in Southern California and I have friends who lost their homes in the fires recently, right? Like this is not a future issue anymore. And
Hmm.
so we need to speed up action. And there's no better way to speed up action than to move money because
Hmm.
money speaks louder than words.
Yeah, no, I mean, it's an interesting thing. And as you well know, a lot of critics of divestment will say, well, these are liquid markets. And if one person sells the shares, just another person will buy them. But you're saying from an investment perspective, the returns aren't great. So there's not like a driver to be invested in this for financially. And then the impact is really addressing the social license issue that you talked about. And it's interesting too, though, when the divestment movement was really ramping up, we did see fossil fuel companies citing divestment as a material risk, that they were actually worried that this could push their stock price lower and impact the cost of capital in a sense, even though it's indirect in the public equities markets. So I thought that was really interesting to see that, like, at scale, the momentum really can not only have this messaging or sort of symbolic impact on the social license, but also a financial impact in some ways. And I think the response we've seen in some states, literally like requiring people to invest in these companies and propping them up that way, also speaks to the fact that there is some potential financial impact there.
Yeah, it's amazing to me that I'll hear a lot of people who are in the climate tech community tell me, oh, divesting doesn't matter. We should not be doing this.
Mm-hmm.
When the fossil fuel companies themselves talk about how they're worried about divestment. And actually, they've started putting a lot of money into moving the conversation and trying to require people to invest in them. Why would they spend so much money? And to be clear, this isn't just me guessing that they've spent a lot of money to try to prevent people from divesting. Influence Map is this fantastic group of investigative journalists who have actually looked at where money from fossil fuel companies is going, and their
Mm-hmm.
lobbying money is directly going to passing laws in red states to outlaw divestment from fossil fuels. So why would they be spending so much money, millions of dollars, on trying to prevent people from divesting if they weren't worried about its impact on their businesses? So I think
Yeah.
that kind of like the biggest proof that divesting matters is that actually they're worried about it, they're focusing on it, and they've made it a really core area of focus now. That means what
Hmm.
we're doing is working. And the other thing is just looking at the historical prices of fossil fuel companies. Big oil used to be in the top 10 of the S&P 500. They used to be some of the biggest companies in our economy, and they're nowhere near the top 10 now. We actually, we exclude them from a portfolio of the top 500 biggest companies in the US by market cap, and excluding them has close to no impact on the risk and return profile of that top 500 index because
Hmm.
it makes up such a tiny portion of the index. So we're still 99% correlated to the S&P 500 just because they've already been in decline for 20 years. They make up almost no part of the S&P 500 at this point in time. And that's just another proof that the divestment campaigns, maybe they have been working. I mean, they still make good revenue, the
Hmm.
oil and gas companies. So I don't think that's what's leading to their decline in stock price. It probably is the successful divestment campaigns at universities, sovereign wealth funds. A lot of entities have already divested. And I'm guessing that is part of what's led to that decline in those stock values.
Yeah. And I mean, from a free market perspective, too, it's just madness to think that governments would come in and say, you can't invest, you have to invest in these companies, and there's this whole movement around freedom to invest that just says people should be able to do their own analysis and, and make those decisions as investors. But kind
Yeah.
of moving on from that, in terms of adding these sustainable or climate friendly options to retirement plans, what are the sort of barriers to doing so? And that, you mentioned when you had your previous company, it was tough to just do it. So what are those barriers, and how does fear kind of help overcome?
Yeah, I spent a lot of time trying to figure that out when I was first trying to figure out why why was it so hard for us to do this at our labs.
Hmm.
And I ended up realizing that there are a lot of climate friendly funds out there. It's not a problem there not being climate friendly funds. It's just a problem that those funds aren't being added to 401k plans. And in trying to figure out why that was, I realized it's probably because the 401k industry might be one of the most litigious parts of the finance industry as a whole. There are lawsuits all the time in the world of 401ks. And that's because there are law firms that specialize in the type of class action lawsuit where employees sue their employers for either having funds that are too expensive in their lineup, or sometimes for having funds that have been underperforming in their fund menu. Those are the two most common types of lawsuits. And so as a result, employers and these fiduciaries who have this fiduciary responsibility and could get hit with lawsuits have really congregated around a very standard set of offerings that um, you know all of them tend to be moving more and more towards index funds. Honestly, these are the funds that have the lowest fees. They don't have to worry about excessive fee lawsuits as much if they have a low fee index fund, and they track the benchmark. They track the economy at large, and so you probably don't have to worry about underperformance lawsuits if you're not picking an active fund manager, if you're just picking an index fund that tracks the benchmark at large. And so index funds have gone up in popularity broadly across the market, but especially within 401ks, probably because of all these lawsuits. Now, if you look at climate friendly funds that exist, pretty much none of them are passive index funds. They're all these actively managed funds where you have to pick a fund manager who's actively picking stocks and hope that they do a good job and meet or beat the market. And you're paying a premium for them to do that. And all of this on a backdrop where there's so much data showing that past performance has no correlation with future results. So even picking a fund manager who's done a good job in the past doesn't mean they will in the future. And so, of course, it's going to feel risky for employers or fiduciaries to add a climate friendly fund if it's an actively managed, expensive fund to their 401k lineup. And so I just started asking myself, why aren't there any climate friendly funds that are passive index funds that just kind of track the market at large? And I couldn't really find any good reason that none existed. I even approached some of the active fund managers out there that do a really good job running some wonderful climate friendly funds and tried to convince them to start a passive index fund. I couldn't get anyone to do it. And so I
Hmm.
realized, all right, I guess I have to do it myself. And so that's what we do at Sphere. We launched our first fund. It's called the Sphere 500 Climate Fund,
Hmm.
and it starts with a bucket of the top 500 biggest U.S. companies by market cap, and then it excludes the fossil fuel companies from that list. And it has a few other screens like deforestation, weapons, private prisons, and tobacco. And the resulting bucket of about 410 companies that are left is 99% correlated to the S&P 500, or has been over the lifetime of the fund, which is 3 years now, plus the 10-year back test prior to that. We price it very affordably. It's 7 basis points. So employers don't have to worry about those excessive fee lawsuits and paying a premium for a climate friendly fund. And then for the companies we do invest in, we vote our shares in favor of climate related shareholder proposals, which we believe is in the long-term financial best interest of plan participants and of shareholders. As long as you're not investing in fossil fuel companies where, having them do less of their core line of business is maybe not in their financial best interest, but for the rest of the economy, installing solar, converting a fleet to electric, usually actually saves them money over the long term. And so you're very well aligned in voting for them to do better on climate, and getting them to set themselves up for financial success. And we're very different than really any other fund that's offered in 401ks typically, in letting people know that you can trust will always vote in favor of these shareholder proposals, whereas most of the other big asset managers are going to be voting against those shareholder proposals every time they come up.
Yeah, that's a really interesting component because, we think about passive vehicles as maybe not having the same kind of impact. And we talked a little bit about the impact that divesting or having kind of a fossil free approach may have. But integrating that voting piece does really support the transition across sectors, right, and all types of companies. That's a really interesting feature. And yeah, I think fees you talked about is a key one that we hear a lot, particularly in this space. Talk a little bit about, it's a mutual fund, and talk a bit about the difference between mutual funds and ETFs and why that was important in this process.
Yeah, it's the weirdest thing. When people launch funds these days, they launch ETFs. They don't really launch mutual funds. They're kind of the dinosaur of the investment world in some ways, because they originate from a time when the internet didn't exist and everything was on paper. Whereas ETFs really, they trade in real time. They're the modern way to do things. But it turns out that the vast majority of the 401k platforms, they call them record keepers. These are the entities that are taking the money from people's paychecks every 2 weeks and putting them where the money is supposed to go and whatever fund it's supposed to go into. The biggest ones and the vast majority of them do not allow ETFs. They just allow mutual funds. And so when we were setting up our company, we realized, well, if we want to be able to get onto 401ks, we need to have a mutual fund, not an ETF. So that's what we did. And it's become this differentiator, interestingly, from other climate friendly funds that exist, in that we just technically can be added to 401k platforms where others can't.
Yeah, I mean, it is fascinating. That's what the retirement space can be tough to dive into because it's complicated. There are all these different moving parts and rules and laws, for good reason, most of them. So that's good. I should have said ETF is exchange traded funds for those who don't know. But nice. So I guess, now that you've created this product, well, actually, let me just, before we move on, tell us a little bit about Atmosphere, which is another product for measuring the carbon emissions of a portfolio. Is that the key driver
That's
of
right.
Atmosphere?
Yeah. So we have two versions of it. We have Atmosphere Starter, which is a free tool anyone can use. They can come to our website right now and type in the name of their company and see how much money is invested in fossil fuels from their company's 401k plan. And we translate that into, if you could move the $100 million that's invested in fossil fuels from your 401k plan out, that's equivalent to taking this many cars off the road or planting this many trees. So it really helps put in perspective the impact people can have if they can get a climate friendly option offered to themselves and their colleagues. And we find that that's really powerful because already for an individual, the most impactful thing that most people can do if they are lucky and fortunate enough to have retirement savings is to move those retirement savings into climate friendly investments. Stop investing in fossil fuels. Just not investing in fossil fuel companies has a huge impact on reducing your personal carbon footprint. But you can expand that impact by making that available to all your colleagues too, especially if you work at a bigger company that has a bigger 401k plan. And it turns out that the single most important factor in getting a climate friendly option added to a 401k plan is employee demand. When employees ask for these options from their employers, Those HR teams then go to their external 401k plan consultants, these 401k advisors, and ask for it. And then those 401k advisors, at the end of the day, they want to keep their customers happy. So they more often than not will add a climate friendly fund when they're asked. If they can find a good one that they find helps check all the boxes as a fiduciary with low fees, good performance, the stuff we talked about before. And so a small group of individuals at a big company can get a climate friendly fund added and then can end up moving hundreds of millions of dollars, in some cases, billions of dollars. If you work at Apple or Microsoft or Google, it's literally billions of dollars that you can move out of big oil by getting these options offered for yourself and your colleagues. So that's really what we highlight with Atmosphere Starter. And then we also have something we call Atmosphere Enterprise. And this is really a tool we're building for sustainability teams at companies to help them quantify the emissions from their 401k plan, and then also understand where's the low-hanging fruit. Are there one or two funds that have really high emissions and maybe also really high fees, like both a fiduciary issue as well as just being bad for the planet? And maybe they replace, we also so we highlight the low-hanging fruit, and then we also give them the language and the tools to understand who within your organization do you work with, right? A sustainability team usually has no idea how 401k decisions get made. So we are kind of giving that training, giving the tools and the language so that they can engage with the benefits team and work with them to get mutual wins, right? Get stuff that helps with employee retention, right? Employees love having these options and helps them believe that employers really mean what they say when they're talking about sustainability. They see, oh wow, we have climate-friendly investment options, so it helps with hiring and with retention, and so it can be a mutual win for the benefits team and for the sustainability team, and that's what the Atmosphere Enterprise tool helps them do.
Gotcha. No, it's very cool. I mean, it's empowering for employees to be able to do that and see the leverage they can have. And so the action there is basically reach out to your HR departments or benefits team to ask the question. And if that doesn't exist, encourage them to add it to the lineup.
Yeah.
And then, yeah, I mean, a really interesting and important point too on the sustainability teams, where a lot of these organizations have climate goals for their own operations. And it's a recognition that the emissions associated with these investments are really a form of scope 3 emissions for the institution or the organization. And so, yeah, it's really loops it in, kind of that core sustainability mission for a lot of these companies.
It's so true. It's an often overlooked scope 3 emission that is starting to get accounted for more and more.
And it's a massive one, as you said. So how are you seeing, I mean, we're all in the midst of really some unprecedented and dramatic political changes and kind of attacks really on some of this work around addressing climate change. Are you seeing that impact your work and the conversations you're having or client demand at all? Or how is this sort of influencing your work day to day so far?
It's funny, we started, well, it definitely, yes, this is the world we're working in. So yes, we pay attention to this for sure. And we actually started this company right towards the end of Trump's first administration. So right at the end of his first 4 years. And it was a time when his administration in the Department of Labor, which is the department that regulates 401ks, they had just put out some guidance saying, like basically trying to throw a wet towel on climate friendly investing. They basically said, but they tried to do everything they could to say you cannot do climate friendly investing in 401ks. But it's interesting because the fundamental law, this act, the acronym is ERISA, ERISA, that regulates 401ks. It's been around for a long time, I think since the early 80s. And it hasn't changed since then. What does change is that the Department of Labor puts out guidance on how to interpret that law. But the fundamental law says you cannot make decisions as an employer on what funds to offer based on personal preference, based on values of the company. For example, let's say it's a Catholic employer. They could not say, hey, our employees are going to have fund options that only align with Catholic values in their 401k lineup. That's illegal per ERISA law. They can only make decisions based on financial factors. So risk and return profile of a fund, fee structure, et cetera. So that's what the law says. You can only pay attention to financial factors when deciding what options to provide employees. Now, so when that Trump administration DOL guidance came out, it kind of just restated that in different words, and they talked about climate in particular and said you can't decide to add something because it's a climate fund or because it's ESG. You have to use pecuniary. They invented kind of a new term and called it pecuniary, but it means the same thing that the law has always said, which is you have to use financial factors. So that was the backdrop we founded Sphere on. And what really encouraged us to found this company was all the data showing how badly fossil fuel companies had performed over the past 20 years. They've already been the worst performing sector of the economy. And so we found, okay, if you have to be making decisions based on purely financial reasoning as an employer, that's a great reason to have a climate friendly option if all you're doing is excluding fossil fuels, because all they've done is drag down returns over the longer term time horizons that matter in retirement, 5, 10, 15, 20 years. There are shorter term periods of outperformance. Interestingly, the fossil fuel sector has also been the most volatile sector over the past 10, 15, 20 years. And so high volatility, of course, leads to short periods of outperformance, but then there are short periods of big underperformance, and it all washes out to be overall long-term underperformance. But we really focused our first product on that data. And so all we did was just exclude those fossil fuel companies, and we have this simple index fund with low fees. And that has set us up pretty well to be able to weather the different administrations. So after Biden got elected, the Department of Labor put out new guidance that was much more friendly towards climate friendly investing. Now Trump is elected again, he's in office, and everyone expects him to probably go back to how things were or do something to try to prevent climate friendly investing. Interestingly, I haven't seen anything happen yet from the administration. I think they've been very focused on other issues for their first month. But something interesting has happened over the past 4+ years, which is the 401k advisory community has become pretty desensitized to the political back and forth. Whereas the first time the Trump administration came out with this new guidance saying only pecuniary, blah, 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 there was a lot of, oh my gosh, are we allowed to do ESG and 401ks? We don't know, a lot of discussion about it. And then as 401k ERISA attorneys started advising 401k advisors, you know what? This is actually the same thing. Like the fundamental law hasn't changed. Just keep doing what you're doing as a good fiduciary. And then, the Biden administration stuff came out and they kept saying, just keep doing what you do as a fiduciary. Don't change your process. Your process is a good one. And as long as you're doing what you do, you don't have to worry about it. That message has gotten out enough to 401k advisors that what we find now is most 401k advisors are not really paying attention to the politics. They realize it's just politics. It doesn't actually impact our process. We need to follow a good fiduciary process, and that's that. And so we actually find that Trump coming into office now isn't really negatively impacting us when it comes to conversations with 401k advisors. Most of them understand that's just politics and people doing what they will in Washington, but it doesn't change our jobs. And something that is impacting us, I would say, to the negative, is that it's all over the news, and that's making people believe they have to make a choice. There's this common refrain that everyone listening probably has heard a lot, whether it's on like the news or the radio or like even senators talking about this. They say, well, you got to choose between investing with your progressive values or investing for good returns. That's something that I feel like it's in a quote book that probably the fossil fuel industry has given Republican politicians to just say over and over again, and Fox News, talking heads, et cetera. You got to choose. The reality is you don't have to choose, as we know. Excluding fossil fuels helps you get better returns, but they're not actually saying excluding fossil fuels gives you worse returns. They're just saying you got to choose. So it's not a real lie, but it lodges in people's minds. And so we are up against this really growing and pervasive belief that investing in a climate friendly way hurts your bottom line. And so that's something that we've really been focusing on changing. And we did something we called the virtual march to retire big oil last year, where we really tried to get the data out there in front of people so they could understand excluding fossil fuels actually can help your bottom line. And we have more campaigns upcoming. We're really trying to just counter that narrative that I think the fossil fuel industry has bankrolled, making people think they have to choose, because it's just not true. And they poured a lot of money into getting that narrative out there. Something that has been helping us with the political side, just to end on a positive note on this question, though, is a lot of people have realized, especially with these campaigns we've been doing over the past year, that the most impactful thing they can do personally when it comes to climate change is move their money into climate friendly investments. And so when the election happened, and a lot of people, I think, were feeling pretty sad about the outcome when it comes to climate change, we ended up getting more and more phone calls of people wanting to invest in our fund. And they were telling us things like, well, I'm realizing I can't control Washington, but I can control my money. I've been meaning to do this for a few months and now I'm doing it. And so, in some ways, the silver lining of the kind of climate destruction that our current presidential administration seems intent on doing is it's, I think, making people realize they actually personally can have a big impact on climate change in areas that are just completely within their own sphere of influence. And people are actually taking action more now, I think, because they're realizing that no one else is going to save us. It's up to us. And so they're
Yeah.
taking more action.
No, that's great to hear. And it is, and I think especially with retirement plans, it's one of those things just naturally people, you know, push off their desk because they have other priorities. It's easy to kind of not
Yeah.
take that step in action and procrastinate. And so, yeah, I think that little prompt is important because it has huge impact. And I do think, you know, in all the sort of chaos that's ensuing right now, the markets are one place where, you know, rationality prevails, hopefully. And so, you know,
Sometimes,
not,
most of the time,
yeah,
over the
yeah,
long term,
exactly.
at least.
Over the long term, eventually. And it is, you know, you talked about the past performance around some of these industries, but there's also the whole concept of stranded asset risk, where, you know, when the transition accelerates and a lot of these assets that fossil fuel companies hold will lose their value before they're sort of taken up out of the ground and turn into useful products because there's better products to help us meet our needs and get around and heat our homes and light our homes and all of those things. So yeah, that's a piece of it too. It's looking forward as we go through this energy transition. I think it just becomes all the more important for investors to be thinking about that. And I think it's really important for people to remember and recognize too that a lot of sophisticated institutional investors have been looking at this for a long time. And that's what's really painful in thinking about some of these retirement plans, some of these rules around pensions, you know, kind of requiring funds to invest in these companies is like, who's going to be left holding the bag? You know, it's sort of most often the retail investors, the little guys who, you know, are at higher risk of, you know, being hurt by that.
Exactly. It's really sad if you think about it, because there is a huge risk that these stock prices could fall off a cliff. And a lot of the big endowments have already divested. A lot of the big family offices, et cetera, have already taken those steps. Some maybe not just because they care about the planet. It's because they can see the numbers and that it just doesn't make financial sense. So it will be really sad if it's just the regular people left holding the bag. And that's why we're here trying to democratize access to climate friendly
Mm-hmm.
investing, make sure that doesn't
Mm-hmm.
happen.
Mm-hmm. Nice. Well, just a couple final questions here. One that we ask every guest is, given all of this in your work, what is your vision for the future of finance?
My vision is that climate friendly investing is just the regular way of investing. Everyone should just not be invested in this industry that's in decline, that has no place in our future of our planet. And everyone should have their shares getting voted in alignment with their values. If you think about it, it's crazy that over 80% of Americans are worried about climate change. Over 50% of Americans think it should be the top priority of the president and Congress. And yet, 98% of the time, their shares are getting voted on their behalf against climate progress at the biggest companies in our economy. The future of finance is that people's values are aligned with how they're actually voting their shares. It's not normal that, you know, it's kind of the rise of index funds, which has been great for saving people money. And we think index funds are fantastic, but it has led to this weird current state where companies are being directed on how to behave in a way that's actually exactly counter to how their shareholders actually want them to behave. And so the future of finance is aligning those two things and people shares getting voted on their behalf the way that they actually believe and in alignment with their values and for a safe planet and a safe home for us all. And where just not investing in fossil fuels is the default option for everyone. And we're going there, starting with 401ks, because that's most people's first exposure to investing is through their 401k. That's how most people kind of learn about investing in the first place. And so we're starting there, especially because there are no good options. There haven't been until we showed up. And then we really want to make these good, sensible options available to everyone everywhere inside 401ks and outside of 401ks.
Nice. Nice. And then finally, it's great to hear your story kind of coming out of MIT and how that led to this work. But what kind of advice would you give to other people that are maybe in college now or looking to get into this industry in terms of what steps they might take to do so?
It's funny because I went to MIT because I needed an excuse to meet people across campus, inventing things. But I ended up while I was there also joining the MIT Divest movement, this group of students at MIT that was just campaigning in front of the president's office in the Infinite Corridor saying, hey, get our endowment out of fossil fuels. And I had never thought about this issue before that. I was getting my MBA, so I'd already worked for 5 years. I had a 401k for my prior employee. It was a climate tech company. And so while I was there, holding up my sign saying divest MIT, I realized, wait a second, am I invested in fossil fuels? And that started me down the path of realizing, wow, even though I worked at a climate tech company, I'm invested in fossil fuels in that 401k, and there's no climate friendly option in that 401k, and I need to get out of that 401k, roll over to an IRA so I can invest how I want. Kind of went through that whole thought process thanks to a student group at MIT that opened my eyes to the issue. So if you're a student and you care about sustainability and finance, I'd say make sure you're joining your campus's divest movement. If you haven't already, and if there isn't one, think about starting one because it's a large pool of money and it makes good financial sense for every endowment to not be investing in this industry in decline. You can learn about finance. It can give you some financial chops just engaging in these conversations with your college's endowment. And you can really help the planet in the process.
Excellent. Alex, well, thank you so much for taking the time. Great to catch up as always, and good luck with everything. We'll talk again soon.
Thank you so much.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.